Good morning, friends. I am Ram Chandrai and you are watching Prayas Vikalp. I welcome you in 11th video of Financial Freedom series. In the previous video, I discussed what is a mutual fund. I discussed the philosophy behind mutual fund. As promised, today I am going to discuss how many types of mutual funds are there, what is the basis of their classification. But before I discuss today's topic, there are two disclaimers. The first one is that I am not rendering any financial advice to you regarding where you should invest. First, you should make yourself fully aware, then you decide where to put your money, maybe in consultation with a competent advisor. So, this is not a financial advice. Disclaimer number two, you will not understand the content of this particular video unless you have seen the previous videos of this series. This is the 11th video, so 10 videos have already come before this. So I will request you to go back and see those videos one by one so that there is a continuity. This is like a classroom. If you have been absenting in the previous classes, you will not understand the content of this class. So you must see previous videos if really you want to understand the content of this video well. One more thing I will like to share with you, that I take live classes. You can attend. You can participate in discussion forum. You can attend personality development program for time-bound result. Only thing you have to do is go to description box, go to our website, see the content, then decide what you want to do. In what form we can help you. Friend, I will request you that if you find any value in today's video, if you find the content useful, please like and share this video to the maximum number of people and subscribe to this channel if you have not done so far, so that you can get very useful content every week, both in English and Hindi. Now friend, let us discuss today's topic: how many types of mutual funds are there. Friend, there are 7 bases for classifying a mutual fund. The first basis is the base asset base. That means in what type of asset the money is being invested. That depends upon the investment objective. That means it can invest money in equity, debt, or a mix. The second classification can be the risk profile. That how much risk the fund is taking while investing. It depends upon the risk profile of the investing group, their risk psychology. The third basis can be the structure, whether it is flexible or fixed one. The next basis can be the nature, whether it is aggressive, is it passive, or it is active. The next can be the investment objective, that is whether it is pure growth, pure safety, or a mix of both. The next basis can be the geography of investment. It could be an international fund or a national fund. That means money may be invested outside country or inside the country. And lastly, it could be open-ended or it could be closed-ended. So these are 7 bases on which a fund can be classified. Now let us discuss the first one, that is the asset-based classification. As I told you, The fund could invest in equity shares purely, or pure debt instrument, fixed income, or a mix of that. If it is a equity fund, it will be a growth fund, which is a risky fund. So it could invest in large cap, it could invest in medium cap, or it could invest in small cap companies, or it could have a mix of that. You know that in India, in Bombay Stock Exchange, 5,595 companies are listed. On National Stock Exchange, 2,629 units are listed. Now, when I talk of large cap, the first 100 companies are termed large cap companies. The next 150 units, that is starting from 101 to 250, they are mid cap, and the rest are small cap. So depending upon in what type of companies it is investing, further classification can be done. Of course, I am going to discuss this issue in detail in my next video. Today I am only going to discuss it briefly. Now I want to give you certain examples of equity mutual funds. If I talk of large cap, Nippon India large cap fund is there, ICICI Prudential blue chip fund is there. They are both are large cap funds. If I talk of mid cap fund, SDFC mid cap is there, Motilal Oswal mid cap fund is there, Nippon India growth mid cap fund is there, ICICI Prudential mid cap is there, Kodak mid fund, so many mid cap funds are there. They are investing in mid cap companies. Now, if I talk of small cap, again Nippon India small cap is there, SDFC small cap is there, SBI small cap is there. So there are plenty of funds. I can't tell everything about all the funds to you, but they are just an example that they are equity funds. Now, if I talk of debt fund, I told you that it could invest in fixed income securities, government bonds, corporate bonds, good corporate bond, debentures, etc., etc. Now, the example could be Aditya Birla Sun Life Medium Term Plan. Then DSP Credit Risk Fund, SDFC Short Term Debt Fund, ICICI Prudential Short Term Fund, Nippon India Short Duration Fund, Bank of India Credit Risk Fund. So there are so many like this. They are investing in fixed income securities. If you want to know their performance, you can go to website, see their past performance, how they have done. You can compare it also. Then there could be hybrid fund. Hybrid means they are investing in equity, debt, and other assets, like they can invest in gold, they can invest in real estate. So they could be multi-asset. They could be, a balance fund. If I give you some example, ICICI Prudential Equity and Debt Fund is there. It is a aggressive fund because they are keeping 65% in equity and rest in other fixed income securities. ICICI Multi-Asset Fund is there. Now they are investing in equity, debt and other asset also. They are giving good return. SDFC Balance Advantage Fund is there. So they are also investing almost more than 66% in equity. So they are certain examples of hybrid fund. Now in hybrid fund, it could be multi-asset, it could be balance fund, debt equity only. So they are the mixed one. Now, as I told you, regarding the risk profile, a fund could be aggressive or it could be conservative. If I give you example of aggressive fund, JM Aggressive Hybrid Fund is there. They put more in equity, less in debt. and they have been giving almost 21% return, annual return. Frankly, in India, aggressive fund is there. They are also investing in more in equity. Kodak aggressive is there, hybrid fund is there. So they are aggressive fund. Aggressive fund be there in any category. So that is the nature. They take more risk and consequently they give more return. But if I talk of conservative fund, they give more importance to safety. They take less risk. So they are called conservative fund. So they are almost putting almost 70-75% of investment in fixed income side and only 20-25% in the equity side. So the return gets diluted, it becomes less. Example could be Kotak Debt Hybrid Fund. It has given annual return of 10.74% only. ICICI Prudential Regular Saving Fund they have also given 10.66%. HSBC Conservative Hybrid Fund is there. They have given 10.32%. And SBI Conservative Hybrid Fund has given 10.20%. So you have seen that if you go to aggressive category, the return could be as high as 21-22%. And if you go to conservative side, it could be 10%, 11%, 12%. So it all depends upon your risk appetite, what type of risk you want to take, what is your nature, what is your status in life, what is your financial position. Now the second categorization I told you, they could be open-ended or close-ended. Open-ended means that you can invest any number you want to purchase, any time you want to purchase, any time you can redeem, subject to whatever taxation is there. So they are open-ended in all this respect, about amount of investment, about the time of investment. But on the contrary, close-ended funds are not available for all time for purchase. They give fixed number of units. The purchasing window is very limited. When the offer is made, new fund offer comes, then only you can purchase within the given window. You can redeem them only at maturity. Of course, you can interchange by trading because they are listed on a stock exchange like a equity share. So you can exit anytime at premium or at discount. So that depends on the market condition. So they are called close-ended fund. The example can be ICICI Prudential Growth Fund Series 2. It has given almost 11%. SBI Tax Advantage Fund Series 2. They have also given 9.68 approximately. SDFC February 2014 one fund is there. So it has also given almost 8.72%. So they are example of close-ended fund, which normally you don't know or you don't go for. Now the second categorization I discuss you about the effort involved in their management. So the fund could be passive, fund could be active. If a fund is active, it is because of the fact that the fund manager has to be very careful, see all the time how the base asset is performing. If the performance is doubtful, then he switches over to better asset. So he goes on, exiting and investing, exit, invest. He goes on doing it. Have to have a close watch on performance of the portfolio. So they are called active fund. Or here more effort is required, more people are required, more research is required. So the expense ratio is also high here. The expense ratio can be as high as 2.5%. I discussed in the previous video about expense ratio. Whereas in case of passive fund, where you have not to do much exercise, the expense ratio is hardly 0.1%. Then what example of a passive index fund are those who are investing as per index position. For example, Motilal Oswal Nasdaq 100 FOF scheme, it has given a return of 22%. It has simply followed the Nasdaq index. Motilal Oswal Nifty Mid Cap 150 index fund is managing about 2500 crore and it has given almost 21%. So you see that they are passive, not much effort is required, they only follow the index, but return is quite reasonable. Motilal Oswal Nifty Small Cap 250 fund is also available. They are managing almost 1000 crore and they have also given return of 20.99, almost 21%. DSP Nifty Next 50 index fund is also there. They are also managing almost 1050 crore rupees and they have given return of 16.59%. UTI Nifty 50 fund is index fund is there. So what I want to tell you that passive funds are not requiring so much attention. You can rest assured, your fund manager can rest assured, it will work as per performance of the market. But active fund try to beat the market, so they want to take a lot of effort, changing and swapping and this and that. Ultimately, it may not happen also, it may happen also. Like in a portfolio management, they are managing each and every security very frequently. But return necessarily may not be very high. But of course, philosophy is like that if you are active, then you expect better return. If you are passive, you expect lesser return. But it may not be always so. The fund can be active or it can be passive. As I told you, the passive fund is cheap and active fund is costly so far its management is concerned. Now, I told you that it could be based on geography. There could be some international fund, mutual fund where you can invest. For example, Aditya Birla Sun Life Global Excellence Equity Fund is there. Fund of fund. It is open-ended scheme. Then Motilal Oswal Nasdaq 100 Fund of fund. Direct growth is there. ICICI Prudential US Blue Chip Fund is there. DSP World Mining FOF Direct Plan Growth Fund is there. So there are like so many funds which are investing in foreign market. Now it depends how that market performs. Accordingly, your return will also be there. Okay. Now the next category can be arbitrage fund. Arbitrage fund, what they do? They take advantage of price differential of a equity share or whatever instrument they are investing. So they purchase in one market, sell in another market where the price is slightly higher, and then take benefit of this arbitrage. So in that fashion also you get some security, some return you can get. Like example I can tell you, Nippon India arbitrage fund is there. It had given almost 7.03%. SBI arbitrage opportunity fund direct growth is there, 7.62%. Kotak arbitrage fund is there. Aditya Birla Sun Life arbitrage fund direct growth is there, 7.6%. So they are also giving you some return through arbitrage. So in nutshell I want to say, fundamentally the mutual fund can be only of three types. Either they will be pure equity, pure debt, and mix of both, and mix of other asset also like gold and real estate. So these are three primary types. But depending upon their nature, in this category also you could have a passive fund, you could have a active fund, you could have a aggressive fund, you could have a conservative fund. On geography you could have a international fund or domestic fund. So there are certain basis of categorizing a mutual fund. Each have their own nature, own objective, own risk profile, etc. etc. So friend, as I told you in the beginning, this is not a financial advice. This is only an awareness drive what I have launched. I hope that this video has made some sense to you and you are going to share and like it and subscribe to this channel if you have not done so far. Friend, in the next video, I am going to discuss equity mutual fund in detail. Its nature, what one should do and how it works. Friend, till then I want to take goodbye from you. But before I leave, I want to request you that health is wealth. So maintain your health, physical and mental both, so that you can perform your duty well. And the second and the very important thing, please improve your personality day by day, inch by inch. Become a better version of yourself. Develop a better skill, better awareness, better behavior. And this particular channel, that is Prayas Bikal, is going to become your partner in this through this weekly inputs. So I will request you to make this partner, this channel, your partner. Friend, thank you very much for giving me so much time.